Are you one of those people who thinks a cheap coin has more profit potential than Bitcoin? That belief is wrong, and it's one of the main reasons many people lose money in crypto. That's why in this video, we'll look at how crypto prices are set, how the numbers you see on exchanges are formed, and why relying on price alone leads so many traders in the wrong direction. If you have not subscribed yet, please hit the subscription button. Now, where does this belief that cheap coins have more profit potential than larger cap coins like Bitcoin come from? This comes from how people are used to buying things in everyday life. For instance, when something is cheap, it feels safe, while when something is expensive, it feels risky. So when new traders enter the crypto space, they carry that same mindset with them. They see a coin priced at 1 cent and imagine it going to $1, while assuming a low price means more profit. That assumption is what we are going to correct in this video. Now, one thing you have to understand is that crypto prices are not fixed and are not chosen by anyone. The number you see in crypto exchanges is simply the last price that buyers and sellers agreed to trade. If no one is willing to trade at a price, it doesn't exist. If you want to know more about crypto exchanges, check out the video where we discussed how the cryptocurrency market works. That's why asking whether a coin is cheap or expensive is the wrong question. Price alone doesn't show value or potential. It only shows where the last trade happened. Price is not decided. It is discovered. And once you understand that price alone means nothing, the next question becomes clear. If price doesn't tell us how big a crypto is, then what does? This is where market cap comes in. Market cap simply means market capitalization, and it tells you how big a cryptocurrency is. It is calculated by multiplying the price of a coin by its circulating supply. In simple terms, market cap shows the total value the market has placed on a crypto at that moment. Think of it like buying a business. A shop selling goods for $1 each doesn't automatically become bigger than a company selling goods for $1,000 each. What matters is how many products exist and how much money the entire business is worth, not the price of one item. Crypto works the same way. This is why price alone is meaningless. A coin can look cheap and still be very large, while another can look expensive and still be much smaller. In essence, without a market cap, price is just a number with no context. For example, a coin priced at $1 with 1 billion coins in circulation has a market cap of $1 billion. On the other hand, Bitcoin, trading at around $90,000 with about 19 million coins in circulation, has a market cap of roughly $1.7 trillion. Even though the $1 coin looks cheaper, Bitcoin is already far bigger. Now you know the market doesn't care how a price feels. It only cares about size. Market cap tells you how much money is already in a crypto and how much more it would realistically need to grow. Once you understand market cap, you stop asking how cheap a coin is and start asking how big it already is. This is also why certain coins may never reach some of the price targets some people talk about on social media. Take XRP coin, for example. With almost 70 billion coins in circulation, price targets need to be looked at through market cap, not emotion. At its current price of around $2, XRP's market cap is already around $124 billion. Now imagine XRP rising to $50. With the same circulating supply, its market cap would need to grow to over $3 trillion. That would mean XRP would need to be more valuable than many of the largest companies in the world and approach or even exceed the market capitalization of Bitcoin. When you see it this way, the question is no longer can XRP hit $50, but where would all that money realistically come from? This is the power of market cap. It doesn't kill dreams. It brings clarity. It helps you separate what's mathematically possible from what simply feels good to believe. But here's the thing. Market cap isn't determined by price alone. Supply matters just as much. A coin doesn't just have a price, it has a certain number of coins available to the market, and that number plays a huge role in how easily the price can move. That's where circulating supply comes in. Circulating supply means the number of coins that are currently available to be bought and sold in the market. These are the coins people can actually trade right now. However, coins that are locked, reserved, or not yet released don't count. To understand why circulating supply matters in crypto, let's use a real-life example. Imagine two markets selling the same product. One market has only 10 items available, while the other has 10,000 items. If many people rush to buy, the market with only 10 items will see prices rise much faster because there aren't enough items for everyone. However, in the market with 10,000 items, prices move more slowly because supply is everywhere. Crypto works the same way. When a coin has a very large circulating supply, it takes a lot of money to push the price higher because buyers have to absorb millions or even billions of coins. But when a coin has a small circulating supply, fewer coins are available, so even a modest increase in demand can move the price quickly. For example, imagine two crypto projects. One has 1 billion coins in circulation, and the other has only 10 million coins. If the same amount of money flows into both, the coin with a 10 million supply will react much faster because there are fewer coins competing for buyers. This simply means that supply doesn't just exist, it competes for buyers. Every coin in circulation is waiting to be sold at some price, and the more coins there are, the more buying pressure is needed to move the market. But remember, supply isn't just about how many coins exist today. It's also about who controls that supply and how fast new coins are added. That's where tokenomics comes in. Tokenomics answers one simple question: who controls the supply and how fast new coins enter the market? It helps you understand whether the supply stays limited or keeps increasing over time. Think of it like printing money in real life. If a government keeps printing more money, each unit of money becomes less valuable because there's more money chasing the same goods. Even if demand stays the same, increasing supply puts pressure on value. But if the money supply is limited and controlled, value is easier to protect. Crypto works the same way. Some cryptocurrencies have a fixed maximum supply, meaning no new coins can be created after a certain point. In some cases, new coins are released through mining, staking rewards, or scheduled unlocks. But remember, when new coins enter the market, they increase supply, and those coins usually need buyers. For example, imagine a crypto project with 100 million total coins, but only 50 million are circulating. If the remaining 50 million are gradually unlocked and released, those new coins add selling pressure. Even if demand stays strong, prices can struggle because supply keeps increasing. This is why token unlocks matter. Price doesn't only depend on demand, it also depends on how fast new supply enters the market and who is allowed to sell it. When new tokens are unlocked, they increase the amount of supply available, and that often creates volatility. Sometimes the price goes up if the market absorbs the new supply. Other times, price drops if selling pressure overwhelms demand. That's why token unlocks don't automatically mean price will fall. They mean price is about to be tested. This is why smart traders pay close attention to token unlock schedules. They know that when supply changes, price reacts. Not because of emotion or rumors, but because the balance between buyers and sellers has shifted. And that shift doesn't happen on paper. It shows up in crypto marketplaces or exchanges. Think of an exchange as a platform that connects people who want to buy crypto with people who want to sell crypto. For example, imagine a local market where people are selling phones. One seller says, "I'll sell for $200. Another says, "I won't sell unless it's $220. On the other side, buyers are saying, "I'll buy at $180, or I'm willing to pay $200. The market itself doesn't decide the price. The price appears only when one buyer and one seller agree. Crypto exchanges work the same way. What you see on an exchange is an order book. This is simply a list of all the prices buyers are willing to pay and all the prices sellers are willing to accept. The buy side shows demand in green color. The sell side shows supply in red color. The price exists between them. This is why price is not a fixed number. If nobody agrees on a certain price, that price doesn't exist. The chart only updates when a trade actually happens. That's why charts don't show opinions. They show executed trades. Now, let's talk about how trades actually happen. There are two main ways people trade on exchanges: limit orders and market orders. A limit order is when someone says, "I'll buy or sell, but only at this price." These orders sit in the order book and wait. They create structure and form support and resistance because they add depth to the market. When many limit buy orders are placed at a certain price level, They create support. When many limit sell orders sit above a certain price level, they create resistance. This is why price often slows down, pauses, or reverses at certain levels. It's not random. It's because real orders are waiting there. A market order is different. A market order says, buy now or sell now at whatever price is available. When someone places a market buy, they consume sell orders from the order book, starting from the lowest price upward. When someone places a market sell, they consume buy orders, pushing the price downward. This is how price actually moves. Here's a simple crypto example. If many people panic and hit the market sell, they don't wait for good prices. They sell immediately, eating through buy orders and pushing prices down. If many people rush in with market buys, they push the price up by consuming available sell orders. In essence, price moves when people choose speed over price. And because each exchange has its own buyers, sellers, order books, and liquidity, the same coin can trade at slightly different prices across exchanges. Remember, exchanges don't set prices, they reveal them. Once you understand this, price stops feeling random and starts to look like the result of real decisions happening in real time. And that naturally leads to the next question. Why do small trades cause big moves in some coins, but not in others? The answer is liquidity. Liquidity simply means how easily you can buy or sell without causing a big price change. A market with high liquidity has many buyers and sellers at different prices, while a market with low liquidity has very few. Think about it like this. Imagine you're trying to sell a phone in a busy shopping mall. There are many buyers around, so you sell quickly without dropping your price. Now imagine trying to sell that same phone in a quiet village with only a few people. To sell fast, you may have to lower your price because there aren't many buyers. That's how crypto works. A highly liquid coin has a thick order book filled with buy and sell orders. When someone places a market order, it barely moves the price because there are many orders to absorb it. A low liquidity coin has a thin order book. Even a small market order can eat through multiple price levels and cause a sharp move. This is why small coins often feel wild. It's not always because they're being manipulated. It's because there isn't enough liquidity to absorb buying or selling pressure. This also explains why panic feels worse in some coins. When fear hits and people rush to sell using market orders, low liquidity coins, such as meme coins, tend to drop faster because there aren't enough buyers waiting. However, in high liquidity coins like Bitcoin, the price still moves, but it takes much more volume to push it the same distance. And once you understand that, the next question becomes clear. If liquidity explains how prices move, what explains why people decide to buy or sell in the first place? That answer is demand. Most beginners think demand means hype. They see a coin trending on social media all over YouTube or mentioned by influencers, and they assume the price must go up. But they forget that there is a wide difference between attention and demand. Attention is people watching. Demand is people buying. A coin can be talked about everywhere and still not move if no one is actually placing buy orders. Price only reacts when attention turns into action. Think about real life. A shop can be crowded with people looking around, asking questions, and taking pictures. But if no one buys anything, nothing changes. The moment people start paying at the counter, demand shows up. That's when prices can move. In crypto, tweets, news, and hype don't move price by themselves. What moves the price is when people act on that information and place orders on an exchange. If buyers come in using market orders, the price reacts immediately. If they hesitate or place limit orders far away, the price barely moves. This is why you'll sometimes see big news with little price reaction, and other times see small news trigger a large move. It's not about how loud the information is, it's about how people respond to it. This also explains why markets often move before news becomes obvious. By the time everyone is talking about it, the real demand is often already exhausted. A good real-life example is interest rate cuts. When markets expect a rate cut, prices usually react early and move fast. But once the rate cut is officially confirmed and actually happens, price often barely moves, because the market already priced it in. Once you understand this, you stop asking, is this coin popular? And start asking, are people actually buying? And that leads us to the final point, psychology. Because even when all the explanations are clear, It's human behavior that decides how people act in the market. At this point, you've seen how crypto prices are actually set. You've seen that prices discovered on exchanges, through order books, market orders, liquidity, supply, and demand. None of it is random. None of it is magic. Yet most people still lose money. Not because the system is unfair, but because they interact with it the wrong way. They ignore supply, skip tokenomics, and never look at liquidity. Instead of doing real research, many rely on social media hype rather than understanding the project itself. Who the team is, how many people are holding the token, how much supply large holders control, the roadmap, or whether tokens are locked or vested for a period like 12 months. Because of this, they often buy after the price has already moved and sell when liquidity disappears and think that charts lie. But that's not true. Charts don't lie. They reflect what buyers and sellers have already done. Once you understand this, the market starts to make sense. Remember, this video is not financial advice. It is only for educational purposes. The crypto market is highly volatile and can wipe out your money if you don't know what you are doing. Do not invest what you cannot afford to lose. If you found this video helpful, like, share, and subscribe. Thank you.